Today we're going to understand interest rates and returns, and I'll just share my screen. Right. So a bit of an introduction of the chapter, and then we'll get going with it. These are the learning outcomes. And I've underlined all the command terms in here. So just keep them in mind when we're going through it. First, we're going to learn how to interpret different interest rates and its different components. Then we're going to learn how to calculate and interpret different approaches of return measurement. After that, we're going to learn how to compare NWRR, that is money weighted rate of return, versus time weighted rate of return, and evaluate performance of a portfolio based on these different measures. We'll then learn how to calculate and interpret annualized return measures and continuously compounded returns and describe their uses. And lastly, we're going to learn how to calculate and interpret major return measures and describe their uses. So first, what is an interest rate? Right? An interest rate denoted by the letter R over here can have three separate interpretations. The first being that it can be looked at as a required rate of return. The second being the discount rate. And the third, an interest rate can also be looked at as an opportunity cost. Now, these two, that is a required rate of return and a discount rate, tend to be used interchangeably because they have an overlapping meaning. The third one, of course, is different. It's an opportunity cost. I'll get into the details of all of this, but just giving you an introduction to the chapter. Now, what are interest rates used for? Interest rates are basically used to reflect the relationship between cash flows which are present at different points in time. So let's say you have a cash flow at t equal to 5, right? This is t equal to 0, t equal to 1, that's 1 year. T equal to 3 is 3 years from now. T equal to 5 is 5 years from now. So let's say you have a cash flow of $100 5 years from now, but you want to see the value of that today, right? So how do you get that value? You have to discount that. Discounting means bringing it back to the present. So you're bringing it back from t equal to 5, which is over here, to t equal to 0, which is over here. And to do that, to bring something back, you have to divide it, right? So that is discounting. So that's where the concept of discounting comes in from. Next, what are the different components of an interest rate? Now, by definition, a nominal interest rate is equal to the real risk-free rate plus premiums. But first, what is nominal interest rate? Nominal basically means before inflation, right? Just remember this. That's the key concept behind nominal, before taking inflation into consideration. So just a paper value, it's the advertised interest rate for, let's say, a home loan, for instance, before taking into consideration any costs or expenses that you use in order to raise that loan. So nominal interest rate or risk-free rate is equal to the real risk-free rate. Risk-free in this case means a government entity is giving you a loan, and that's the rate. Of course, you can't use that as a retail trader, but for the purposes of understanding, we're going to take risk-free rate into consideration, which means it's a government bond, also known as treasury bill, treasury bonds, depending on the period, right? So real risk-free rate, risk-free in this case, as I said, is government bond plus certain premiums. Now, what are these premiums? Broadly, there are four, of course, there are more than these, but broadly, there are four key premiums to keep in mind. There's an inflation premium. That is, the premium is a compensation for a certain risk. So inflation premium is a compensation for inflation risk. Default premium is a compensation for default risk. Liquidity premium is a compensation for liquidity risk. And of course, maturity premium is compensation for maturity risk. I'll get into the details of what these are later, but let's just understand what is the significance of time value of money first, or TVM for short. So TVM is used to establish a point of equivalence between cash flows that occur at different points in time. Right? This is the underlying concept. You want to find a point of equivalence between cash flows, which are, let's say, present at t equal to 0, which is today, and t equal to 1 year, right? So let's say you have $9,500 today, and you choose to, instead of choosing to consume something with that money, instead of buying something, you say, all right, I'm going to invest that. I'm going to put that in a bank. And I'm going to take that out 1 year from now. So the first thing you're doing over there is that you're delaying your consumption. Of course, we all love to consume today, right? It's the utility of consumption. We all want to consume today rather than tomorrow. But if you're not consuming today, if you're giving up that consumption today and you're delaying it into the future, you need some sort of remuneration, some sort of compensation for that fact. That is how we get, that is what that value of money is used for. So we know that a cash amount received today is preferred to a cash amount received in the future, as I just said. And hence, you need to be compensated for that delayed consumption. It's not that you're not going to get to consume, it's just that it's delayed. So time value of money helps extract this compensation for delaying or even preponing for that matter. Because let's say, for instance, I choose to invest $9,500 in a bank today and I form a fixed deposit and I say I'm going to take it out a year from now. So now the bank has earmarked that money and they use that in their regular operations for giving out loans. Then we don't need to get into the details of that now. But basically, when I give them $9,500 and I say it's for 1 year, they keep that in mind that it's for 1 year. But for some reason, if I decide to withdraw it earlier, let's say I want to spend it on something, now I'm breaking that promise, right? Let's say 6 months from now, I decide I want to buy a car and I decide to pull out that money. So they had expected that they'll get to keep the money till here, which is 1 year from now, but they're having to pull it out 6 months earlier and give it back to me. Due to that, their business operations are affected. And so they'll charge me a prepayment penalty for that. Right? Again, we don't need to get into the details, but I'm just explaining where the concept of delaying or preponing comes from. Now, as we saw over here, $9,500 today is $10,000 a year from now. But how do we get this point of equivalence? How do you know that? So first of all, let's find the difference between the two. 10,000 minus 9,500 is $500, right? Now this is a difference or the gap which is preventing the equivalence. Had it been $10,000 today and $10,000 a year from now, you wouldn't care. You would say, okay, if I have $10,000 in my pocket today and I'm getting $10,000 a year from now, it makes no difference. Why should I delay consumption? The only reason I'm delaying consumption is because I'm getting some extra compensation. So in order to achieve the equivalence, in order to make this 9,500 into 10,000, there's a gap which needs to be bridged, right? And that gap is the interest rate. So first thing we do is find the difference between the money a year, the amount of money a year from now and the amount of money today, which is $500, right? So now you basically need a return of $500. That is, once you add $500 to this 9,500, it becomes 10,000. So you need a return of $500 on an investment of 9,500. So a return of $500 on an investment of 9,500 in addition to the initial 9,500, okay, to become $10,000. Now this is 5.26% as I've already calculated over here to save time. So the return on an initial investment, you need a return of $500 on an initial investment of 9,500, which comes up to 5.26%. So let's grow that amount of money. Let's take 9,500, which is at t equal to, sorry about that. Yeah. So t equal to 0. Or let's just go back to the timeline over here. Yeah, t equal to 0, 9,500 in order to go from t equal to 0 to t equal to 1, you have to multiply that. Always remember, when you're taking it forward, you multiply. And when you're coming back, you divide, right? So when you're taking 9,500, you multiply it by 5.26%, taking into effects compounding. That's where the 1 plus comes in from, right? Raised to n. Now this n in this case is 1 year. So I've kept it as 1. So 9,500 today at t equal to 0 when multiplied by 5.26% plus 1 accounting for compounding will give you $10,000. Actually, it's 5.263%, but I've rounded up to two decimal points. So you get 999.7, 9999.7, But yeah, if you take 5.26317.9%, then it becomes $10,000. So basic, let's not focus on that. The core concept to focus on over here is the fact that $9,500, when growing at 5.26% annualized rate for a time period of 1 year, at the end of that 1 year, you will get $10,000. So now you have extracted R, in this case, 5.26%, which is the compensation that you get for giving up consumption of the $9,500 today. I hope that's understood. Now, let's understand the different components of an interest rate, right? As I mentioned over here, it can be broken up into three separate parts. One is looking at it as a required rate of return. The second is looking at it as a discount rate. And the third is an opportunity cost. Now, one and two are overlapping. Basically, a required rate of return, as the name suggests, is a minimum amount that you require to accept the risk of making an investment, right? The second is a discount rate, which is what we just solved over here in the example earlier. 5.26% is the discount rate which is used. And thus, interest rates are broken up, as I mentioned earlier, required rate of return and discount rate, and you can use them interchangeably. Opportunity cost. Now, this is the value or the benefit that you derive by foregoing the consumption today, right? Just a moment. So yeah, it's the value or the benefit that you derive by foregoing or by choosing by foregoing consumption or by choosing a certain course of action, in this case, which was foregoing consumption. So in the example earlier, if the individual chose to consume, then they would have foregone that 5.26% because they would have just used up that money. They wouldn't invest it in a bank, they wouldn't get the 5.26%, right? So that 5.26% is the opportunity cost. Now, how do we determine interest rates? Interest rates are basically set by the forces of supply and demand in a market. So supply is from investors and demand comes in from borrowers, right? So investors, I'll just take a retail example. Let's say I have a certain amount of money, 9,500 or $10,000 in this case, and I go and deposit in a bank, right? That's where the supply is coming from. Now, a bank uses that to originate loans. Let's say they pool that money, by the way. It's not just one person. They have millions of retail accounts. They pool that money and use that to originate loans to different corporates. Let's say a manufacturing company. So that's where the demand comes from. There's a manufacturing company, let's say Ford, manufacturing cars, and they want to start a new plant somewhere. So in order to start the new plant, they need to raise capital. They come to a bank and they say, all right, we need $1 million. So the bank says, okay, we have a certain number of accounts. One account is deposit $10,000. One account is deposited $4,000. Another account $20,000. They pool all of these accounts together. Once they reach the amount that is required by the borrower, they originate that loan and they charge them a rate of interest. So the borrowers have to pay a rate of interest, let's say 7%. And I, as an investor, or in this case, as a supplier of funds, I have deposited my money with the bank. So I need some remuneration, as we discussed earlier. That remuneration would, let's take to the example, 5.26%, right? This is the bank, the intermediary. So the bank takes money from me, right? Gives it out to borrowers. They take that 7% from the borrowers. Out of that 7%, they give me 5.26% and they keep the spread. 7 minus 5.26%, they keep the spread. That's the whole business model, keeping the spread. I mean, that's a broad business model in this case. So now let's take into consideration the point of view of an investor, that is a supplier of funds, where an interest rate is looked at as a real risk-free rate plus certain premiums. Now, A, B, C, and D, as I showed over here, are inflation premium, default risk premium, maturity premium. Wait, let me just show you that page. Yeah, inflation, default, liquidity, and maturity, right? Now let's do a further breakdown. What is real risk-free rate? The real risk-free rate is a single period interest rate, where the single period can be either okay. bit of an issue to write. It can be a day, a week, a month, or a year, or any period of time, but it's a single period, right? So you're only talking about that particular period. So the real risk-free rate is a single period interest rate for a completely risk-free security. So let's say a government bond, a treasury bill, for instance, under the assumption that no inflation is expected. I'll repeat this point. The real risk-free rate is the one period interest rate or single period interest rate for a completely risk-free security under the assumption that there is no inflation expected. Now, in economic theory, a real risk-free rate is used to reflect the time preference of individuals for current consumption versus future consumption, which is something that we discussed earlier as well in this time value of money example, right? You're choosing to consume 1 year from now instead of consuming at t equal to zero, which is today. That's what this point is covering. Real risk-free rate is used to reflect the time preference of individuals. Time preference means how much compensation do you want for delaying your consumption. So now let's look at the premiums in detail. First, an inflation premium. Actually, let's get back one step. What is inflation? In broader terms, inflation means something which reduces your purchasing power. Right? I'll get into the detail in economics, and as we go further, I'm just drawing an outline right now. So in broader terms, inflation basically reduces your purchasing power, right? So you need some sort of compensation for that. So that's the first source of a premium. It compensates you for expected inflation. Again, another important point to keep in mind. It only compensates you for expected, but not for unexpected inflation. So it does so by reflecting the average inflation rate over the majority. Let's say in this case, it was 1 year. So it takes into consideration the average inflation rate over a period of 1 year and incorporates that into the premium. Next, default premium or default risk is the compensation for a failed payment, either in amount or timing or both. So, what does that mean? Default premium is compensation for default risk. So, now let's say instead of investing in a government bond, I invest in a corporate bond, which is, let's say, triple B rated. Okay. Now, triple B rated bond is obviously going to have a higher default risk than a triple A rated bond. So basically, a triple B rated bond means there's a higher chance of the borrower not paying you back, either at the right time. So let's say you expect a payment once every 6 months or semi-annually. They might not pay you once every 6 months. They might just mess up the payment. They might delay it for some reason, or the amount might be lower than expected, or both. That is, they pay you an amount which is lower than expected, and they pay you later than expected. So that is default risk. Next, liquidity risk. Liquidity risk is the lack of ability to convert to cash quickly. Quickly means instantly in this case. So I'll just give you a broader example. Let's say you buy a home and you want to sell that off because you have an urgent need of funds for for any reason. It could just be for a hospital bill or something, or something catastrophic has happened in life and you need to sell some assets. Now, if they are illiquid, like a home or land or anything, or gold, no, gold is still liquid for, but if it's a home or a land, now that's going to take some time to sell. You can't convert it to cash quickly. But if you have a fixed deposit, you can just break that fixed deposit, it gets converted back to cash. Or if you have gold for that matter, just go to a jeweler and sell that gold and you'll get your money. It could be at a discount, of course, but you'll still get some money immediately. That's the point of liquidity over here. So liquidity premium is compensation for the liquidity risk which comes in from your lack of ability to convert it to cash quickly. So I've just highlighted the point that we need to understand the difference in maturity premiums, which is coming next, of treasury bills versus corporate issuers. So treasury bills do not offer a liquidity premium, right? While regular issuers must offer one. Why is that? Now, before I give you the answer, I want you to think about that for a bit. And so you can pause the video at this point in time and think about it. But yeah, once you come back, I'll continue. So liquidity risk, as we just mentioned, is the lack of an ability to convert into cash quickly. Now, treasury bills or treasury bonds are government bonds, right? They are backed by the government. So they are assumed to be 100% risk free, in which case you can quickly convert them to cash. But regular issuers, in this case, means corporate issuers, you cannot quickly convert their bonds to cash. First of all, they're not even issued at the same frequency as treasury bills or treasury bonds. And secondly, they're not traded that frequently. So the volume is lower, the trading frequency is lower. And for that reason, corporate issuers tend to have higher liquidity risk because you cannot quickly convert it to cash. If you want to convert to cash, you cannot do it quickly. But for a treasury bill or bond, you can quickly do it. That's the difference, right? Because it's backed by the government, whereas a corporate issue or a regular issue is not backed by the government. The maturity premium is also known as term premium, and it offers you compensation for the length of time for which you choose to stay invested. Now, let's look at this timeline. If I have $100 today and I say, okay, I'm not going to consume that money, I'm depositing that in the bank, I'm going to consume that 1 year from now. So the bank will say, all right, we'll take your money and in return, we'll give you, let's say, 0.4% interest. Again, I've come up with these numbers randomly. These are not actual numbers, just for explaining the point over here. $100 invested today. I say, all right, I'm delaying consumption. I give to a bank for 1 year. They'll give me 0.4% in return. The same amount of money, had I kept it for 2 years, it would be 0.9%. Why is that? Because now I'm delaying consumption for this incremental period, right? From t equal to 1 to t equal to 2. Now, there's two things to notice over here. First is the fact that even though this interval is still 1 year from t equal to 0 to t equal to 1, and from t equal to 1 to t equal to 2, the interval are both still 1 year. Despite that, the compensation for the second interval is slightly higher, right? 0.5% over here and 0.4% over here. Again, I'll explain why later on, but just notice the fact that as you go further down the timeline, the same interval will still fetch you a higher compensation for delaying consumption. So basically, when you're delaying consumption, you can see from t equal to 0 to t equal to 1 is 0.4%. From t equal to 0 to t equal to 2 is 0.9%. That is, you're adding up the compensation for the first year and for the second year. And now from t equal to 0 to t equal to 5, the compensation is 1.9%. That is, you're getting the compensation from t equal to 2 all the way up to t equal to 5, in addition to the compensation from here and from here. Right? So that is what maturity premium is. Basically, compensation for delaying consumption for intervals of time. Or you can even view it in a graphical format where you get to see the fact that as you go, as time increases, right? Time is on the x-axis. And we have maturity premiums on the y-axis. So as you increase in time, as you go along the x-axis, the maturity premium increases. So it's directly proportional to time. Now, we're going to understand what is nominal risk-free rate. As I mentioned earlier, nominal means after excluding inflation. So it doesn't take inflation into consideration. So a nominal risk-free rate is equal to real risk-free rate plus expected inflation. Now, the actual way of looking at it is 1 plus nominal is equal to 1 plus real risk-free rate into 1 plus expected inflation. And this is the approximate way of looking at it. That is, nominal risk-free rate is equal to real risk-free rate plus inflation premium. And if you don't recall this, we can just go back to breakdown over here to understand where the premiums come from. So you can just rewind the video to this point to revise it. Now we look at the quoting convention. So typically, interest rates are quoted in annual terms, right? Annualized terms. So the interest rate for a 90-day debt security, for instance, is actually the annualized rate and not the actual rate which is earned for that 90-day period. Now, within an interest rate that is quoted is also the implicit assumption that it contains the real risk-free rate plus the premiums. So unless otherwise mentioned, it's implicit that it's taken into consideration the inflation premium, the default premium, the maturity premium, right? And now to summarize everything that we've learned, we're going to go through a few examples. So I prepared that in an Excel sheet, and I want you to focus on this now. Just a moment. So these are different investment alternatives and all of their investment characteristics. That is, we have an investment for time t equal to 1 to t equal to 5. We have maturity, we have liquidity, we have default risk, and then the different interest rates which correspond to all of these characteristics. So now let's go through all the questions. Question one, we have to explain the difference between interest rates offered by investment one over here and investment two. So let's just go through investment one and investment two, right? Let me just highlight these. Now, both of them have the same maturity, both are 2 years. Both of them have the same default risk, that is low. But still, investment two is offering you a higher rate of interest, 2.5% versus 2% in investment one. Where is that coming from? That is coming from the liquidity premium over here. Investment two has low liquidity. Now, let's revise what was liquidity risk. Liquidity risk is the lack of an ability to convert to cash quickly. So because this investment for some reason is illiquid, maybe it's a corporate bond, you cannot convert it to cash quickly, and so it has low liquidity, which means the premium will have to be higher. If the premium is higher, that's where the 0.5% is coming from, right? So in this case, in investment fund, since the liquidity is high, you do not need any compensation for that fact because you can convert to cash quickly. So since the liquidity is high and you can convert to cash quickly, no compensation, which means you don't get that extra 0.5%, which you get in investment two for having low liquidity. So that's question one. Question two, explain the default risk premium, right? Which is affecting all of the securities. So let me just remove this. Now we have to explain what is the default risk premium affecting all the securities. So in order to explain the default risk premium, we first have to identify two investments that have the same maturity. So focus on this column now, column B, which have the same maturity, but different levels of default risk. All right. So we have two groups of investments which have similar maturities, investment one and investment two, both of which have 2 years maturity, and investment four and investment five, both of which have 8 years of maturity. So these are the two groups of investments we have to focus on, right? But now specifically, investments four and five both have a maturity of 8 years, but different levels of default risk. And that's why we picked this group. Because investment one and two, although they have same maturity, the default risk is same. Both of them are low. But investment four and five, along with having the same maturity and the same liquidity, they have a difference in default risk. So this is the point where the default risk compensation will come from, right? So investment five has a lower liquidity and therefore will bear a liquidity premium relative to investment four. Higher default risk means you have a higher risk that the person will not pay you back, if you recall, either in amount or timing or both. So because they may not pay you back in time or the amount might be different from what they promised you need compensation for that risk. That's why when default risk is high, that investment will have to offer you a higher rate of return. So now from the first question, we know that liquidity risk is 0.5%. Remember, when we calculated liquidity risk between two investments which have the same maturity, one was low liquidity, the other was high liquidity. So the low liquidity one had to offer you a higher compensation, right? So we knew that that was 0.5%. So let's write that down over here. Liquidity risk compensation is 0.5%. Now, the difference between the interest rates offered by investment 5 and 4 will thus be this 6.5 minus 4, which is 2.5%, right? But out of this 2.5%, out of this 6.5 minus 4, 2.5%, 0.5% is liquidity. So 2.5% is the total difference, and 0.5 is coming from liquidity, right? So the core reason for default risk is only 2%, right? So I hope that's clear. Now, the third thing we're going to do is we're going to calculate the upper and lower limit for the unknown interest rate. So I'll just share my screen now. I'll just pause the share my screen now for a moment. All right. So now we have to figure out the upper and lower limit for this unknown interest rate. That is for investment number three, right? So now investment three does have liquidity risk and default risk, which is comparable to investment number two. Let's look at that. Liquidity risk low in investment three and low in investment two. All right. Default risk low in investment three and low in investment two. All right. So these two characteristics are comparable. Now, investment three has a higher maturity premium, right? It should have one because you're investing for 7 years over here, whereas you're investing only for 2 years over here. So because you're investing for a longer time period, and if you recall the diagram, maturity premium is directly proportional to time. So the compensation will also be proportional, which means that you will have to have a higher compensation for investment three versus investment two. Therefore, the interest rate on investment three should be higher. Now, how much higher we do not know yet, but it definitely has to be higher than 2.5% because if these characteristics are the same, and so the only point of difference, then this point of difference can be used to figure out the fact that compensation in investment number three will be higher than investment number two based on the maturity premium. Now, let's think about this for a moment. If liquidity, that is now we're looking at column C, if liquidity in investment number three was high, that is instead of low, had it been high, right? So I just changed that now. Had it been high, it would match investment number four, right? Because investment four also has high liquidity. So we could then conclude that investment three's interest rate should be less than the interest rate offered by investment four, which is 4%. Why is that now? Because if these characteristics are the same, right? Liquidity risk is also high now, default risk is also low. Then the only point of difference is coming down to maturity. And since its maturity is lower in investment number three, the compensation would be lower, right? So we could then conclude that investment three's interest rate would be lesser than the interest rate offered in investment four, which in this case is 4%. But now, in contrast to investment four, investment three has lower liquidity. So we'll go back to what it was originally. It has lower liquidity. So it is possible that the interest rate on investment three can still exceed that of investment four despite having a shorter maturity. How is that? This can depend upon the relative size of the liquidity premium and the maturity premiums. However, we would still expect the unknown rate, that is R3, to be less than 4.5%. How is that? 4.5% is the expected interest rate on investment four if it had low liquidity. So let's look at investment four now. If it had low liquidity, right? Then 4% is what you would get as compensation, which is already mentioned, plus an additional 0.5% because now the liquidity is low. So that 4 plus 0.5 gives you 4.5% had it been low, but it is high. It's actually high, right? So the compensation has to be less than 4.5%. So that's why we expect the interest rate offered by investment three to be between a range of 2.5%, that is above investment number two's rate, but below 4.5%, which is this 4%, plus another zero point 0.5 had this been lower. We're bringing it to lower because we need to compare it to investment number three. So let me revise the range now. I think this part, the first part is fairly clear that since investment three has a low liquidity risk, which is similar to investment two, and has a low default risk compared to investment two, which is, I mean, low default risk, which is also similar to investment two. So there's no point of comparison over here. The only point of comparison is coming in the maturity, which means investment three has to fetch you a higher maturity compensation or a maturity premium. So it has to be higher than 2.5. So that part is established. Now, investment three versus investment four. All default risk is low, default risk is low. So no point of comparison over here. Now, there are two things to look at over here. Maturity is different, liquidity is different. Now, for 1 minute, let's make the liquidity similar, just so that we can focus purely on the maturity. If liquidity is similar and default risk is similar, we get to focus only on the maturity. Now, because this maturity is lower, that is investment three has a maturity of 7, whereas investment four has a maturity of 8. The one which has 7 as its maturity will fetch a lower compensation. So that means it has to be the compensation has to be lower than what you get in investment four, right? So right there, it has to be lower than the compensation you get in investment four. But investment four is 4% over here. Now, had this been low, had the liquidity been low, then you would have to add this additional 0.5%. So 4 plus 0.5 gives you 4.5%. And that's why the range is 2.5 to 4.5%. So that's the end of part one. If you have any questions, you can drop them in the comment section and I'll reply to them. I hope you enjoyed the session. Thank you. Thank you.